Hello, everybody, and welcome to the weekend deep dive of the M3 Market Update, your one-stop shop for all things housing and commercial real estate. Welcome back to the show. Today I'm going to be talking about loss mitigation at the request of a viewer. This is going to be something that, just as I talked about last week, we need to set the foundation of what's to come over the next, I'll say, several years. But essentially, as we start to see borrowers come under distress. And then just quickly, I'll tell you that in the portfolios I oversee, I'm definitely starting to see some weakness. What you can see is that at the end of 22, people were getting behind, they were stressed, and then they kind of got caught up in that tax and bonus season. And that's very seasonal, that happens often, but where I'm seeing most borrowers are back where they started in December, and they're what we call rolling forward to delinquency, rolling from under that 30 days to 60, 90, because a lot of borrowers know that you do that credit reporting, at that 31st day, etc. So most people try to stay underneath that 30-day mark, and it's when they start to roll that you know that you've kind of lost them. So first, let's just start by defining loss mitigation, because it's a very interesting term, because you could ask yourself, loss mitigation, what loss are we trying to mitigate? Are we trying to mitigate the loss to the borrower? Are we trying to mitigate the loss to the investor? Okay, well, that might even sound confusing. And so basically what happened during the GFC is you had a lot of people get involved in the mortgage industry, a lot of regulations, a lot of government bodies came in, and everybody kind of agreed that loss mitigation was supposed to be about helping the investor and helping the borrower. Now, I think we could all argue whether who got helped, essentially. But we will say that the landscape changed significantly post the GFC, and we'll talk about that a little later. But before we even get started, I think it's important to define some terms. So first, originator. Who is the originator? The originator is who gives you your loan. It's just as simple as that. Bank, non-bank, whatever. They give you that loan. Now, what happens, and this is what a lot of people don't understand, is once you get that mortgage, typically it's immediately sold if it's what we call a qualified mortgage, meaning it is qualified to be delivered to the agencies. It's immediately sold, but that originator could do something like retain the servicing right. What is a servicing right? Well, first, let me just tell you what servicing means. Servicing is essentially the taking of your payments every month. So your servicer is the person or the entity that's going to be responsible for taking that payment and then helping you, like if something goes wrong. Let's say you get a tax bill in the mail, but you're escrowed. They're going to work with you to make you feel better that, hey, we're going to take care of that tax bill because you're escrow. We've got your funds sitting right here. We're going to advance it. Importantly, they're who you call when you are experiencing some sort of distress. So that's your servicer. So servicers get a tiny fee. It's embedded in the origination of that loan for servicing your loan. And the idea is that with performing servicing, it should be very easy to do because most people aren't delinquent. They pay every month. Even if they get behind, they get caught back up. But the problem is once you start getting further down that default path, which often happens with FHA loans, etc., that's when expenses start to increase. And so the idea is if it's a FHA VA, which is those are sold into the Ginnie Mae Securitization Trust or Fannie Freddie, the idea is that these entities will reimburse you for any unexpected expenses or any expenses. The idea being that really the only expense to you should be just kind of your what we call cost of service for just taking those payments. But that's not exactly how it works in reality. And we'll talk more about this over the next months. But a lot of people get into the FHA game, for instance, because they see these fees. They think, oh my goodness, I'm going to make a killing. What they don't realize is that these entities act like any other entity you've ever sent an insurance claim to, and sometimes even worse. So a lot of times that's just going to get rejected out of hand. And so you have to be very careful about those expenses, documenting them, etc. And you have to have huge entities or groups within your organization that are there just to submit these claims and monitor them and talk back and forth. The more that you guys come to understand this entire business, you'll understand that making money in it in the right way a long time ago it's a failed proposition. What I mean, you're thinking I'm crazy. You look at these, big originators, they're making bank. You look at the servicers, they look okay. Well, again, I've talked about this is the in-between time. Just wait, because the GSEs know how to get their money during a hard time. And we'll talk more about that in terms of claims and repurchases. But today we're talking about loss mitigation. And this is the concept of when a borrower comes under stress, what kind of loss mit options are available to them. And I'm going to go through that today because things have changed significantly from the GFC and then now on top of COVID. Understanding the delays, the amount of money that's actually being pushed back to the ends of these loans is staggering. And I will be working on getting some of those stats, to display for you guys on a go-forward basis. But just understand that the reason why borrowers are not in default is because of the unprecedented amount of these loss mitigation options, as well as most people after the GFC stopped doing anything that wasn't going to be delivered to the agencies. We have a smaller component today called, non-QM. They focus on these loans that we'll talk a lot about, like these DSCR loans, etc. But they're a very, very small part of the business. And hardly anybody gets in just to play there, not anymore. And so essentially most loans that were originated during the COVID boom were going to be these Fannie Freddie loans, these FHA loans. And so today we're going to go through some of these programs so you can understand how long it's going to take for us to really see delinquencies rise. That's one thing. And then two, once you see the amount of government money and involvement, I think that it might give you a different picture of where we may be heading for in terms of home price depreciation, as well as issues as we get into the default process. A lot of what I'm going to talk to you today about, it may sound familiar to some people who were in this space back then, because if you ever heard of a silent second, a piggyback loan, things like this, these are things that, you can't do outside of these programs. You can't do, we'll talk about origination, down payment assistance in a future show, but just put it this way, the government has stepped in to sort of push people to make riskier lending than they would have necessarily. But as my friends at your dollar university say, I think that most people that play this game understood that if they even tried to do some of this, it still wouldn't be worth their while, because essentially they went through what happened before when contract law went out the window. What do I mean by that? Well, you sign a contract when you take out a mortgage, and once all of the big five are under the consent orders, contract law was completely broken, meaning that we couldn't enforce our contract. And the things that were being levied against the industry at that time were very, very serious claims. And people did some very wrong things, and I'm not saying that. A lot of, signing of documents they shouldn't have signed and things like that. But did it warrant breaking contract law? And could there have been another way to do this? Well, these aren't answers that we got back then. but I have a feeling we're going to start thinking about them and talking about them over the next several years. So let's just dive in to some of these programs. So let's talk about FHA first and HUD. So a lot of people call this government-backed subprime, and I can tell you that it is not, it is some of the riskiest for an originator servicer to do because the claims process can be so onerous. And I'll tell you that most people in this space today, they don't look at origination and servicing together. They actually look at origination separately and servicing separately. So no one talks about a cost of a mortgage. They talk about the cost to originate. They talk about the cost to service. So they don't say, hey, if I originate and service a loan, this is my life of loan profitability. Nope, no one does that. They talk about the businesses very separately. And I'll contend that they do that, there's a reason. Because we're pushing money around more than making money in this huge securitization process. And we will, again, I will do deep dives on this. It's so important to understand this, to truly understand housing and then also its place in the economy. We talked a couple of shows ago about the Hope model from Cantro on Twitter and how so many people think of housing as this massive machine, and it is. So it's important to understand it and important to understand it's not going to behave the way you might think that it's going to behave. Okay. So the first thing I want to do is just talk about what FHA HUD came out with early this year. They essentially took what had been COVID loss mitigation options, and they basically said we're gonna retire, we're gonna pause our other options, we're gonna use these COVID options until October of 2024. Now, October of 2024, for many people, that can take on some very specific meaning because it's the month before November 2024. And I think we all know what's coming then, and that's an election. Now, what I want to tell you about these programs is that back in the day, there were all sorts of requirements, and these were required by the agencies. It's not even the servicers. And so kind of going back to everybody's role, you've got the originator, you've got the servicer, and then you've got the investor. And the investor, that's sort of who Fannie and Freddie take care of in most situations. There's all different complicated things, but really they're looking out for their investors. And so often what can happen is that the servicer is put in the middle of all of these different entities that have very vested interests, but a lot of them conflict. And so when you hear that your servicer says they cannot give you a loan modification or any other loss mitigation workout, they're following Fannie, Freddie, Ginnie's rules. They're not just arbitrarily making that decision. So I think a lot of times, certain people get a bad rap, but I think what we all need to come to understand is that mortgage has changed, and it's more of a public, meaning government process, versus the private markets these days. Even though a lot of people would kind of look at securitization and think private, well, the GSE is government sponsored, and they run the biggest securitization machines, okay? So just know that when you call in to ask for something, you're not really talking to your servicer. You're talking to the requirements of the GSEs and FHA, VA, etc. Okay, so, and one other thing that I really want to talk about here is, speaking of those requirements, one of the biggest things that changed during COVID is some of the requirements over acknowledgement by the borrower, signing of the documents, even talking to the borrower. So a lot of certain loss mitigation options, you could automatically put the borrower in without even agreeing. And that happened during COVID because everybody was worried, like, what if we can't talk to the borrower? So a lot of things kind of went out the window for some of these COVID solutions. And, sometimes there were different requirements for owner occupied versus non-owner occupied. Those things kind of went out the window too. And so a lot of what I'm talking about will sound similar, but it's the deep requirements within each that changed, because we'll talk about during the consent order. If you were a servicer and someone called in and said, I want to be reviewed for loss mitigation, it wouldn't matter if you reviewed them last week and nothing had changed. You would have to stop the default action and do a full review. If they didn't send everything in, then you'd have to send them this incomplete acknowledgement. This was a very complicated process that basically just meant you were constantly starting default actions. And every state is very different, but some states have a ton of rules about how you can do that, why you can do that, etc. And so in some states, if you did stop it, you had to start all over again. And then there's something called the statute of limitations. So there were all kinds of forces making it very difficult back then, but things got a little simpler with the CFPB when they came in. And then now with COVID, you don't even, in many of these workout solutions, you don't even have to talk to the borrower, essentially, for COVID. Now, some of you probably heard the National Emergency Declaration has ended. So what FHA did is kind of came out before that and said, hey, so you don't have to worry about that, when it's ending, when it's not. We're just going to make our COVID options available till October 24th, like I kind of talked to you guys about. So essentially, these can sound a little crazy to you because if you're on a forbearance, let's say you missed 12 payments, you can take those 12 payments and put it into a non-interest bearing lien that sits at the back of your property. At the back of your loan, that essentially it's going to be paid off when you refinance or when you sell the property. So, or when you essentially pay off your loan in case you won the lottery. So it sits back there like it didn't exist. It's not gaining interest. And this is huge if you think about it. It can only be about 30% of your UPB. But let's pretend I'm one of these Airbnb investors that I took out one of these second homes, even though theoretically it would have been a first home because I was a first-time home buyer. That essentially I couldn't make my payments for 12 months. And we had one of these guys on a call on a Twitter space that I did. He couldn't make it, and so he was able to do what we call the partial claim for FHA to essentially take that and put it at the back of the loan. And so essentially it's like those 12 months just go on to the end, the idea being hopefully they can sell it, etc. It lets them get back on their feet. There was also this thing for FHA that's in place now called the ALM, and that's a loan modification. Now when you think of loan modification, this means that you are modifying the terms of your loan. So this loan modification, essentially, back in the day, before COVID, you would have to send in what we call a complete application, all your financials, almost like you were originating that loan all over again. And you would have to call in and you would have to ask for all of that. Now, what happened with COVID is that essentially you don't have to call in. The servicers were required to review you for that option and then send it out to you and say, by the way, you've been approved, sign this document to say that you accept it. So a lot of things changed in COVID around borrower responsibility that I don't see going back in many ways. Maybe some of the more traditional programs, but I just have a feeling, essentially, that these are going to stick around, which means that, the potential could exist that we're giving workout options to maybe folks that don't need them. Again, I'm all for helping struggling homeowners, but I want us to understand or get a picture of the consumer when it comes to this space. And it is very complicated. And so mortgage delinquencies are not going to tell us much. Okay, so we talked a little bit about one of the big things that was used during COVID was the forbearance. And essentially, again, you didn't have to give a doctor's note. You didn't have to tell them what was going on. You just called in, you said, I've been impacted by COVID. I need help. And then they would help you. They would give you this forbearance. And for those of you that maybe have had trouble with your mortgage before, you'll know that this was very different. So the forbearance was kind of the basis of all of the loss mitigation workouts during COVID. And guess what? During that forbearance, people weren't allowed to credit report. That's another big thing. And so, again, we have no concept of the health of the consumer when looking at mortgage. So important to remember as we start hearing delinquency measures. Basically, all these borrowers that got this assistance just kick the can, guys. They put it at the end of their loan, which is going to get a little hairy once we get down the default cycle. Because what if they're in Austin or Phoenix or in California where home prices have already depreciated? Well, they could be underwater already because of those partial claims. So, okay, so just wanted to talk to you a little bit about the forbearance. So we've kind of gone over that. That's simply calling in saying, hey, I've got a COVID impact, I need a forbearance. Now, with the national declaration ending, I think the last time that those can be started by a servicer are May 31st. However, you have to be out of it by November of 23. But that's okay, because now we have these other options, which is that what we call the standalone partial claim, which can be up to 30% of your UPB that you can put on the back of that loan. Now, another big sort of program I want to talk about today is the home, let's see, what is it called? It's HAF, and it's Homeowner Assistance Fund. Sorry, I just know it by half. And this is a big deal. This is basically $10 billion that was sent out to the states for them to give assistance for taxes, expenses, things of this nature. You know, if people had any COVID hardship, et cetera, they could use this homeowner assistance funds. Again, $10 billion, and nobody has used it all. In fact, I can tell you people got started kind of late using this, but all of that money is going to be going into these workouts. And I guarantee you that a lot of what we saw in the getting caught up at the end of 22 was also probably related to these homeowner assistance funds. And so the GFCs, HUD, everyone is going to be doing whatever it takes to keep these borrowers from defaulting. And again, when we're talking about FHA, these are typically lower income borrowers, first time home buyers. So just remember that when we're looking at these delinquency metrics, if we had not had this type of government intervention, we would be seeing unbelievable spikes in delinquency. Just completely, again, the COVID word, unprecedented. Okay, so that's kind of FHA. There's all kinds of state programs too. You know, this is the federal, the homeowner assistance. Your state had to apply for those funds, but everybody got it. So just know that when you're thinking about delinquency in your area, so maybe you're looking to buy a home, maybe you're an investor, just know that timing is never going to make sense because there are so many programs out there. Now, we're going to move over to Fannie and Freddie, and I'll talk about programs they all kind of share in common as well, including FHA. I'll start, that's the short sale, and that's basically where if you can sell it, and maybe it's not enough to cover your mortgage, it'll cover that. You'll go sell it, and then the bank agrees to accept it for those lower amounts of funds. So that's the short sale. And then there's something called the deed in lieu, which essentially that's kind of where you just hand over your deed and you say, you know what, I just can't do this. Now, it's interesting. One thing that happened at the end of the last crisis, just if you want to think about good guys and bad guys, and I would argue there's not many that are either or, but at the end of the last crisis, Fannie and Freddie actually started pursuing what we call deficiency judgments, and I can remember thinking, what is going on? This makes no sense. I'm being forced to kind of do everything I can to go up, outside of my contract to help borrowers, which we were glad to do. Meanwhile, Fannie and Freddie were actually pursuing them for the deficiency of what they, let's say if we took them to foreclosure, you would have an affidavit. That affidavit would list everything that was due and owing. And there could be a ton over what you actually, what that property was worth. And then you get what we call a deficiency judgment. Well, then Fannie and Freddie were pursuing that. They hired a company to go pursue borrowers, which I thought was kind of crazy back then. But it just goes to show you that it's important to know the actors. It's important to know the motivations. And there's not a ton of good guys, and not a ton of just bad guys. It's just a bunch of people in a machine trying to make money. Okay, so moving over to Fannie Freddie, they don't have the partial claim. That's kind of with FHA, you get the full faith and credit of the U.S. government. They do things a little bit differently. They do have a forbearance. They came up with what they called the payment deferral, which was very similar to the partial claim in that if you did that deferral, you could put all of your arrears or that 12-month of arrears into a lien at the back of the property. So they did do that. Then they had their standard modifications that they offered. But first thing they're going to offer you is what they call a simple repayment plan. When you call in and they can say, hey, well, maybe you've got 2 months of back payments, that's $1,000. Can you pay $250 a month, for 4 months? And that's a simple repayment. But then let's say your hardship gets worse. They take you through what they call the waterfall. And that's essentially going through all the different options you might be eligible for. Again, that could be a forbearance, a payment deferral, a modification, a short sale, or a deed in lieu. So there's a ton of different things that offered to help you out of this situation. Okay, so I will be talking a lot more about this. There's so much to say about these different programs, but I think the most important message that I want to talk about today, or to get across today, is that there is a ton of government assistance already out there. Now, once we start seeing delinquencies rise, once we start seeing truly, struggling homeowners, because another thing I can tell you is that if you looked at the efficacy of some of these FHA programs, once a borrower is in that deep of distress, and let's say that their, taxes and insurance have gone up, it's very hard, no matter what you do, to get that borrower back on track. And in a situation where home prices are depreciating in some areas, and I believe they will continue to do so in most, we'll talk more about that in the regular M3 update, this is going to be a problem. So hopefully this little summary helps you guys understand loss mitigation a little bit more, how it can impact our view of the mortgage consumer. If these programs, even if we didn't have something like the partial claim, which by the way, Fannie and Freddie never did anything like that with a payment deferral before. So this is a big, big deal. And it's available. Essentially, what it feels like is these entities are trying to make up for about a 25 to 30% impact in home prices. Now, they're not doing that explicitly, but if you can essentially, with one of the modification programs with FHA, reduce your principal and interest payment by 30%, etc. I think this is one of the ways government's going to step in and kind of manage the gulf between those insane home prices and where we ultimately end up. Now, I'm not saying someone sitting at FHFA or somewhere like that figuring all this out, although I do think some people there are aware of this situation. I've got colleagues that work there who have seen this all before. So I think there are some folks that do understand, and that's why some of these programs work the way they do. But just be wary when looking at news reports about delinquencies being way down, not being concerned about credit quality. And this, let me say this real quick. Credit quality is not a concern so much right now, but let me tell you, neither was it in 2005 and 2006. And so I am seeing in the portfolios that I watch degradation in credit scores. Pretty soon we'll start to see degradation in loan to value. This is where credit quality becomes a concern. And with the bank crises and failures, essentially this, I believe, the credit crunch is upon us. And as that credit crunch comes, how does that hurt your normal borrower? Let's say that maybe the credit card company says, you know what, we need to reduce your limit. We're worried, people are, we've seen incredible credit card spending. So suddenly they don't have access to that. And unfortunately in the US today, people don't look at their salary for what they can spend. They look at all of their available credit. And so the minute that credit starts to get impacted, then you're going to start to see other things. It's just kind of dominoes. So, maybe they were paying for groceries on their credit card, their power bill with cash, and now they can't use their credit card for groceries. So credit quality, we are going to start to see it deteriorate. I'm already seeing it. We'll probably start to see it in everybody else's reports in about 2 months, maybe a little bit sooner. It depends. So the story is very muddy. It's very mixed, and it's important to understand all of these really boring topics if you're looking at any type of mortgage metrics to understand where the consumer is, because the consumer would have been in a whole lot of trouble if not for these government programs. And that the concern that I have is, and maybe it's delayed, but how are they going to be able to sustain even with these programs? I think it's going to be a challenge, which means that, people, the government will step in with additional programs. I was going to talk about that earlier, but something like HARP or Home Affordable Refinance Program, depending on where we are with rates. So they will step in with additional programs. However, is it going to be enough? That's the question, and that's what I'll be helping us to monitor in the M3 Weekly Update. So I'll be doing these deep dives on the weekends, maybe not every weekend, but often. So please tune in. I hope this wasn't incredibly boring, but there's just a ton of information, a ton that's changed since the GFC, and I'm just trying to give you kind of a good picture so you can understand what's really going on out there, what's going on, kind of with the consumer, and how that should, color your view for whatever you're trying to do, be it buy a home or invest, etc. So anyway, I'm M3 Melody on Twitter, M3_Melody, Melody Wright on LinkedIn, M3 Melody on Substack, and now here on YouTube. Please check me out. There's a lot going on. There's a lot of confusing data, and so it's going to be critical to sort of dive in and understand all of these different component parts. And I'm here to hopefully help you do that. So thanks again for tuning in. I really appreciate it. Have a great rest of your weekend, guys.